So, hello and welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Charanjit Singh, Fund Manager at DSP Mutual Fund. Welcome, Charanjit.
Thanks. Thanks for having me on this session.
Great to have you here. Can you share with us what initially sparked your interest in equity investing? And also, given your extensive experience as an analyst before stepping into fund management, why did the transition happen at that particular point in your career? If you could please share with us.
Yeah. So if you look at what really excited me about equity research was that if you look at stock markets, they are all about, the most smartest people working and trying to, make money and also trying to learn a lot. So I think the equity research is all about learning. You're constantly learning, you're evolving, you are seeing the data points changing. You have to understand global macro, you have to understand the domestic macro. So I think the amount of knowledge enrichment which happens in equity research, I think rarely you will find other professions where you can have so much of learning. Second is in terms of interaction with the industry leaders, in terms of looking at businesses from a perspective that various business cycles are there. That is what again, excited me, that you can be part of these, journey of companies which can go through different cycles and see them growing. And the amount of excitement which comes with that when your, stock calls go right and even when they go wrong. So there are different kind of, pressures which also come in. But I think equity research provides you that platform where you can use your analytical bent of mind. You can, process a lot of data. You have to also look at behavioral aspects. So these are all the things which really excited me when I looked at equity research as a career option. Now, when you asked about, this transition which happened from sell side to fund management. So I think as I've spent, 16 years close to that in the sell side research. So sell side is all about covering certain set of stocks, doing very in-depth research on those stocks, and constantly coming up with your recommendations. So you are an opinion maker. You are not a decision maker. So this is a journey which any analyst has to do, transitioning from being an opinion maker to becoming a decision maker. So in sell side research, what happens is that an equity analyst will come up with recommendations. He will constantly track those companies, those data points, and recommend it to the fund managers. Fund managers are the ones who are going to deploy the money and who are going to take the decisions. So I think that is where the power shifts. When you are going to deploy the money, you have to take that responsibility. I think that was another important thing which in anybody's career happens, that you have to look at that now I have built my knowledge base. I've looked at the cycles. I understand the industry, but my, industry focus is only maybe particular one or two sectors. How do I broaden my industry, understanding and get into various other sectors? Plus, take the responsibility of managing the money. So the transition, how it happens for an equity analyst is, first you are on the sell side, covering stocks. Then you become a buy side analyst. Then you come into the buy side or the asset management company, start covering the stocks there, recommend it to the internal fund managers. And as your hit rates improve, then the fund manager responsibility starts coming in. And I think it is a very essential process for anybody to go through this phase of learning. Because if you haven't gone through that grilling, you will not be able to take the right calls. You will not be able to take big calls which are required when you are managing money. So I think this is how the transition happened for me. Definitely in between, I had got opportunities in terms of, getting into the fund management role. But at some point of time, then you need to decide whether you're ready to get into that mode or not. So I think that is a point of time when came for me that I decided that DSP is offering me a very good opportunity in the asset management and a good career progression. So I think the other thing is when you get into asset management, it means that you are going to become an investor. It means that your career path longevity could be much longer. You can keep on investing in companies till 80s, till 90 years old. And that is what keeps your brain sharp. That is what keeps you excited and motivated in life.
Mr. Singh, as you mentioned, it was quite challenging and quite hurtful to see being a research analyst. So transition from being a research analyst to a fund manager must be quite a journey.
Yeah.
What were some of the pivotal lessons you learned during your time as an analyst that have provided invaluable in your current role as a fund manager?
Yeah. So I think that's a very important question because those learnings only come in handy when you are managing the money. And one is, when you are a sell side research analyst, then you are covering the companies and you are interacting with the managements. You see how managements are behaving, how managements are, giving a guidance and running the business. So at the end of the day, in any company, it is a promoter or the senior management which plays a very important role. That is one thing which you learn as a research analyst on the sell side. Second important aspect is how the industry dynamics are structured. So industry is a very important part because if your overall market size or market is not growing, then you may not have companies which may be able to re-rate. You'll not be able to make money in the sectors which are not growing because stock market only focuses on growth. The other aspect is in terms of the quality of the financial parameters. So in terms of understanding the forensics, in terms of understanding the aggressive accounting, all those aspects are very critical when you are doing the research on the sell side as a research analyst. And when you come to the buy side, you use those same tools to actually analyze companies. But then on the buy side, it is more above and over and above that. On the sell side, you may, focus only on the good calls and you may even forget about your bad calls. But in the buy side or in the asset management companies, your bad calls will come to bite you as much as your good calls because your bad calls can actually lead to a lot of underperformance. So that is where the hit rate is one of the very important thing which a buy side or asset management company has to focus on. Because if my hit rate in terms of taking the right calls is there, I'll be able to generate a better returns. But if my hit rate is low, then I will not have any place to hide. Underperformance in any kind of a way in the fund management industry will always be visible because that is a track record which a fund manager is building. So I think that is where it is very critical to utilize those tools which I have learned in the sell side in terms of the business cycles, valuation cycles, quality of the managements, forensics, also the behavioral aspect. So when on the sell side, the main job is that once you finish writing your reports and give a stock call, you're out marketing. You're talking to fund managers, not only in the domestic market, but globally. So you're able to see how different fund managers have different ways of thinking. Somebody is more value oriented, somebody is more growth oriented, somebody is even comfortable with a high P multiple. Some fund managers may want a low P multiple. That is how in the fund management or what we see is that the stock market is structured. So that also gives you a good perspective that how different asset allocators or investors are looking at this market. What are the critical things or the stock drivers? So different stocks or different segments will have different drivers for their growth. So for example, in capital goods space, you will have order inflow as one of the important drivers. If the order inflow is weak, stocks may not re-rate. In the power utilities, the capacity utilization or capex, what they're going to do, that is going to be an important parameter for re-rating because that will drive their future earnings growth. In the consumption space, the demand patterns are very important. So I think that is what you need to understand, and that is what you get it from the sell side in terms of what are all the important drivers. Then on the buy side, it comes terms of improving your hit rate, allocating the money, and sizing up the positions. That is what is a difference when you come into the asset management industry.
All right, now coming to your role as a fund manager, you co-manage 3 funds alongside Rohit Singhania. Could you shed some light on how you two collaborate in managing these funds and how do you divide responsibilities basically and work together effectively?
Yeah, so if you look at different funds like the Tiger Fund, which is an infrastructure-oriented fund, then you have the Opportunities Fund and Tax Saver Fund. So different funds have different philosophies and different kind of, the instructions in terms of how we run those funds. Now, the point is that there are multiple sectors which get covered under these various funds. So on a regular basis, we need to track, how different sectors are, performing. Whether there is a sector where there is a thought process emerging that it could underperform for a longer time, or there is a sector where the outperformance can start coming in, and then what is your index weights? Based on that, then you define your underweight, overweight, or equal weight positions within the sectors which are allocated in the individual funds. While Tiger Fund is more of thematic fund, others, funds have more specific benchmarks which have to be followed in terms of how the sectoral allocations happen. So in terms of our process, so we have a, team of research analysts who will, feed into the ideas to us in different sectors. We will constantly evaluate these, stock ideas which are coming from the team. We'll see that what is the kind of potential upside which is there, and then the existing stocks which are there in the portfolio, how do we need to, whether we need to trim them or we need to increase their weights. So that is a constant work which happens. That is why it is called an active, asset management. It is not a passive asset management, because you are constantly evaluating what you are holding, whether your weight is right, because like I mentioned earlier, hit rate. Because if I'm not able to pick that particular space at the right time, I may miss out on the right kind of alpha. Now, for giving an example, now PSUs have seen a significant, uptake in the past, couple of months. What we are seeing is that if you had a framework which said, I will not invest in PSUs, then you might be missing out on the alpha which was generated. So it means that we need to constantly track that what is changing in the PSUs, and then take a call that which are the PSUs which we should be allocating to. So that is a, responsibility which we divide among ourselves, that these are the sectors which I will look at, these are the sectors which Rohit will look at, and then constantly discuss that what are the assumptions what street is forecasting. See, ultimately the stocks move when there is a strong momentum in the earnings, and this momentum has to be higher than what street was expecting. That is where the re-rating happens. So that is where we have to do constant work in terms of looking at the financial models, in terms of looking at the industry models, then taking a call on the sectors that maybe we have to go IT overweight or we have to go banks overweight, and then decide on the weights. Because if we get those weightages wrong, then we'll not be able to beat the indices. That is where the entire, work goes on in terms of allocation of looking at the sectors, then looking at the stocks, forming our opinion in terms of what could be the upside, doing a lot of discussion in terms of questioning that why do we think that this assumption is right and why do we think this assumption is not right, and how, the industry is also positioning itself, how the, stock market is also perceiving all those things. So I think there are multiple parameters then we need to evaluate. This is very stock specific, but then there are also a lot of macro factors which you're looking at, how interest rates are moving, how currency is moving. So I think it is an amalgamation of all these things which go into our decision making. So there you need to have a team who divides these responsibilities. Every day track your portfolio, track the positions, look at new ideas. Now what we have also seen is a lot of IPOs coming up. So when you look at IPO market now, it is, becoming really very hot. So it means that while as a house, we are not very keen to invest in a lot of IPOs, but definitely we'll have to evaluate those companies. So that evaluation has to be again split between, me and Rohit. Okay, that, how do we evaluate this? What is the kind of extra work which we want to do? Constantly doing dealer checks, constantly doing, discussions or meetings with the companies. So that is how the work, gets, divided amongst us.
Mr. Singh, given your background and expertise, what unique value do you bring to the table while managing these funds?
Yeah, so I'll touch upon the Tiger Fund. So Tiger Fund, I've been managing on my own. And if you look at Tiger Fund, is a thematic fund. When I started managing Tiger Fund in Jan 21, so the main, thought process was that how we can make thematic or cyclical funds less cyclical, less volatile from the returns perspective. So what I did is, because of my background in most of these sectors, I did thematic fund studies in the global markets. What are the factors which are leading to an impact on the earnings or the returns for the shareholders in the thematic funds? So I think the most important problem statement was that how do we de-risk that in terms of the thematic funds? So thematic funds are lesser risky than the sectoral funds, because of the fact that there are multiple sectors you can invest in. Sectoral fund will have only particular sector and maybe limitation of stocks, maybe 30 stocks, 50 stocks, and sector will have its own cycles. Suddenly you see that pharma sector is doing well, but then the demand drops. Most of the stocks will start behaving in a very similar way because their earnings get impacted. Either they'll be, very domestic driven, or they'll be, more international driven, but most of the stocks will then move in a pack. So that increases your risk and you have a lesser room to move around. So what I brought to the table was, one, in terms of my understanding of all these sectors, be it, defense, be it power, consumer electricals, durables, real estate as a sector, infrastructure, construction. So these are the sectors which I had tracked for a very long time and gone through the cycles, looked at the promoters very closely. What are the kind of, issues which happen with these companies? At what level the growth starts stagnating? What are the important, government policies which we need to track? And another important point, Chirag, the thing is that you have to be ahead of time. Why I'm saying that is that if you are able to identify a theme much ahead of time than the street, then you will be able to build good sizable positions and you will be also able to get at a good price. So that example is like, for example, defense sector. Now, defense sector, what was changing was that government started making policies which led to import bans. So if you are not able to track that, what are the government policies you need to track, you will not be able to take this call. Then once you have seen that, then you have to take a call within the defense space, whether you want to go for defense PSUs or you want to go for private players. Fine. So that's one call which will help. Not only are these three funds, but the entire fund house, because the other funds will also participate in the defense opportunity. Fine. Now coming on to the power sector. So most of these sectors where I have a very deep understanding, we try to do a lot of demand supply modeling. We try to do a lot of industry modeling because that helps us build a broader view on the sector. Then we get granular that within this sector, which are the parts of the value chain as a house we want to participate in. Now, the power sector understanding helps us because power is a very huge sector. Now, it is not only about utilities, but it is also about the equipment players. It's also about the contractors. So, and each business has its own, different kind of parameters to track. So I think that is where each segment we have built our competency based on my track record, be it water, be it defense, be it, consumer electricals, real estate. If you don't want to play real estate, how you can play it through proxies, like maybe building materials, maybe cement. So now again, coming back to that question, how do you reducing the risk in the thematic fund? If I don't want to participate in the metal sector, is there other better way to participate in metal sector? Maybe refractories is a very good play. So I think that is where the knowledge of the sector is very critical to build positions, to identify themes and ride them also for next 3 to 5 years. Otherwise, what will happen is that you have taken a trade, you have already doubled your money. But if you don't have that longer term perspective through your demand supply models, through your industry models, you may exit the trade very early.
Mr. Singh, just going forward about it, you manage, you were the analyst of the till 16 years and you started managing the fund since 2021. And a year back in 2020, we saw one of the worst crises in terms of market crash. So what were the key lessons you learned during that particular time, which has helped you in the fund management business?
Yeah, so I think that's the, corrections are part of the life. If you look at the market history also, it is not that correction has happened for the first time. There have been multiple corrections which have happened and the drawdowns have been also, to a significant level. So, but I think that is where when you are taking a call and you're saying that I am buying businesses, I am buying, these companies because I believe in their businesses, what will happen in next 3 or 5 years. See, these events, one is like a lot of these events are very short term. A lot of times, when the events happen, there's a fast reaction from the governments, the central banks, so that the recovery starts happening. So what happens is that if you are a seasoned investor and you have seen the cycles, you will see corrections as a very important opportunity. Now, why I'm saying that is an important opportunity? Because see, a lot of times, maybe I like a stock, but it's too expensive. Quality stocks are generally very expensive. you know. And the point is that these corrections, as an investor, as a fund manager, everybody should use to improve their hit rate by adding good quality stocks, because that is the time when a lot of these stocks are actually at discount. There's a sale going on, and if you get fearful, then you will not be able to improve your returns. I think these points at that point of time, if you have a very clear thought process that one, these companies will survive. These are good quality companies, and these companies have the ability to rise. Why that will happen? Because their balance sheets are strong. Their management is very strong. These companies have built their brands or their, a product portfolio, which cannot be replaced by any other, product. So when you have that kind of an understanding and you are owning a business, then when that correction comes, you'll not be afraid. You'll say, this is a business which I wanted to buy, but this was maybe trading at 40 times P multiple. Today it is trading at a significant discount, maybe at 30 times P multiple. Then you become greedy. Then you start adding those positions higher, because that is the time when you add those positions, the amount of return which they will generate in your maybe personal portfolio, in the funds, that is going to be really significant. And that is going to be the real game changer. So I'll use corrections as an important entry point in some of these, very good high quality stocks.
Now, coming to you as an investor, how would you describe yourself? How would you describe your investment philosophy, and what type of stocks or context or opportunities are particularly intriguing to you? If you could come up with some anecdotes there.
Yeah. So if you look at my investing style, so it is, kind of based on two approaches. One is like analytical plus a visionary approach. Now, why I'm saying that? One is that you need to analyze a lot of data before taking any kind of a call on a particular stock, right? Because that will only help you build the position and size the position also. Whether I want to hold 1% of that stock or 2% or 5% in my fund, that allocation will depend on my conviction, which will come from the data, right? So data will tell me, okay, that these are the things which have happened in this sector or the companies in the past. But what vision is talking about is what can happen in the future. So like, I'll give you an example here. Now, when we talk about power sector, in the power sector, you could participate it through transformer companies. You could participate through cables and wires companies. You could participate through utilities, right? So as an investor, one is I'll see that least risk, better profitability, which is a segment which I need to participate in, right? So one is, as an analytical investor, I'm looking at a lot of data, which I've talked about just now in terms of the demand supply models, right? So that has given me a clear thought process that if I look at this 15, 20 years data, this was the trend which has happened. This is how the industry operates. These are the main demand drivers for power. This is how the power deficit has played out. This is how domestic demand for power is playing out, and this is how industrial demand is playing out. So that is the half of the exercise which I'll do. Next half is in terms of projecting. While I agree that you will say that nobody knows what will happen in the future, but the point is that you are taking a calculated call. You are taking a call on the future based on the data which you have seen. So when I'm saying that, why I'm saying that is that in a lot of these places, you are able to take a calculated call because you have seen the cycles. You can say that, okay, power demand will now grow at a much more faster rate, that maybe at around 7 to 8% versus 5.5% what it has grown in the last 10 years. But then you are taking a call because what you are seeing is underlying trends changing. People are using more room ACs. Industries are coming up which are more manufacturing oriented. That is what is going to drive the demand. So there you are taking a calculated call. And then you also do a lot of groundwork in terms of meeting with experts, in terms of meeting with policymakers. And then you build up your opinion based on a mosaic theory that you have, taken a lot of inputs. And now this is your thesis that these stocks, power sector stocks, if you see, most of the stocks were available at very cheap valuations 2 years back. Some of the larger utilities like NTPC and all, they were trading at below 1-time price to book. And that part of time, nobody was even willing to add these stocks. But what we said is that our data is showing, one, this demand growth will pick up significantly. Second, it is not only sometimes domestic data which will help you. You have to also look at global data. And what global trends we saw? If you look at Europe, when Russia-Ukraine war started, Russia cut off the gas supplies to Europe. They started facing real power crisis. So it means that power sector suddenly started seeing power prices going up in Europe. They wanted to burn coal-based power plants. And these were the guys who were very negative on coal-based power plants, which is called ESG. And that is where the derating was happening. So it means I am collecting my data from domestic market, from international market, piecing it together, and then taking a call that whatever these assets today they are trading at such cheap valuations, they'll re-rate from here. And they will re-rate because of these factors, which will also come in terms of higher power demand growth, higher deficits, and capacity addition in power takes time. So then we'll take a call. Okay, I can buy a lot of these players in the power ecosystem. I can buy utilities, I can buy contractors, I can buy cables and wires companies, transformer manufacturers. So one industry level work helped us take a call on multiple subsectors. Similarly, if you see water sector, if you see like 5 years back, government never used to talk about water sector. Water was a given thing. But now today, water is one of the priority sector for government to do spending. But that is only one data point. Then you see where is the government spending that money? They are making sure that water is reaching every home. Then you see that once this water project is getting executed, who is going to be the beneficiary of this? And what is the quantum here? Whether this is going to happen only for 1 year or it will happen for next 3-5 years. Because if it happens for 3 or 5 years, I have a good runway. My companies can continuously grow their earnings driven by this theme. So deciding on the timeline, deciding on the theme, all these are very critical from a fund perspective to take a call on those sectors. So that is what defines my philosophy. One is, constantly looking at how the mega trends or the trends are evolving in the market. Making sure that we are ahead of time in those trends, because then only you will be able to capture right valuations. If we are having a wrong entry price, we will not be able to make the amount of money which we can make when we are ahead of the street. Second is looking at segments which are not fragmented. Consolidated markets help you make your profitability, which is more sustainable. Right? Third is that the market is definitely growing. If the market is growing, most of the players will benefit. Within those segments also, we constantly track the demand supply models. Like in transformers, today if you go and ask for any manufacturer, they'll say, sir, please come after 6 months, 1 year, we don't have capacity. So suddenly the pricing power is coming. That's also showing you that the demand is massive and our thesis is going right. So the point is that you need to constantly also track your thesis. That, okay, I had thought this, whether it is happening or not. Like you will say, nobody knows whether it will happen or not. So it means that you have to constantly do that hard work in terms of tracking those data points. How is the demand growth tracking? How is the water capex happening? How is government doing railways capex? So I think all those data points are there. But as an investor, I would like to be conservative. I would like to be ahead of time, very conscious about the valuations. And I think in the portfolio, when we are looking at stocks which have re-rated, so I think another important question here is that if you look at the market right now, the stocks have re-rated very significantly, So then it becomes a hard or tough market because the stocks will not be able to generate significant return. So at any point of time, then you evaluate the stocks which you're holding and you see that these stocks have already, factoring in maybe next 2 or 3 years earnings, multiples are at peak. Then you take a switch call that I want to switch out of this stock and move to another stock. So selling is also a very important aspect. As an investor, while I'm buying stocks, but selling is also very important because that is where you're able to book your profits. And that is again where you need to have a process that if I'm selling this, why I'm selling this, that is what we do as a part of our framework and process. We document everything. When we are building our position and when we are exiting the position, we document it. So I think documentation is also a very important part of our entire process, which helps us also go back in time and see why we took that decision. So I think as an investor, you need to have these guardrails, focus on valuations, right companies, focus on promoters, good quality, growing markets. And see, sometimes you may even be looking at some special situations. See, a lot of times when you see in the market, there are companies which would be coming out of a very lean phase for a very long time. Then what do you do? Because history will show you that these companies have not done, or performed in terms of earnings growth, their margins have collapsed. So those are, special situations, or those are where the turnaround is going to happen. So when you are building our portfolio, you need to also have the companies which have that capability. But there, the risk perception could be much higher because, again, the timing factor plays out. Because they may not turn around in the next quarter. Maybe they take 1 year, maybe they take 2 years. So that is where you manage that with the sizing. You don't have a very high size allocation to those kind of stocks, but have an optionality that when they turn around, then the amount of return which will come in is going to be phenomenal. So in the fund, what I will do is, as an investor, I'll have stocks which can continuously compound. I will have stocks which will have the ability at cheaper valuation to re-rate in terms of PE multiple or the valuations, as well as earnings growth. I'll have a portion which will also be special situations or special situations in terms of turnarounds. I think that gives a good, fund structure which can help you deliver on the returns.
Mr. Singh, with regard to the stock selection in the portfolio, what criteria do you look for when considering compelling buy of a stock?
Yeah, so see, compelling buy is based on right now what is the expectation which street has in terms of future growth rate. Why the stocks derate is when a street is expecting that the company will grow by maybe around 15%, but they are able to deliver only 5% kind of a growth. Then there is a big mismatch which is there in terms of what expectation is there and what the delivery is there, right? So compelling buy is that when I'm able to get a stock where the expectations built into the stock price is very less. Along with that, the valuations are cheap, but the company has maintained its balance sheet well, and it is only going through a rough time or the weak cycle. Because we know when the cycle turns back, then these companies will be able to give us a good return. So compelling buy is you have to constantly monitor that what is being factored into the stock price, what is the future growth rate, what the street is factoring in, whether the return profile or ROEs, what they're delivering right now, can they improve from here? So sometimes the ROEs may be depressed because they are in a weak cycle. Margins are depressed because they are not getting a pricing power right now because the end market demand is weak. So I think that is where when the segment is supportive, the company has the capabilities, and the future growth rate expectation is not excessive, that is where we are able to make a compelling buy idea. Now, for example, if you look at Kirloskar Group, right? If I look at some of these companies, they were, going through a rough patch for last 10 years. If you look at PSUs, even they were going through a very rough patch because of the way they were being governed, their capital allocation issues, and that is where the valuations were cheap. NTPC below 1 times price to book, while it's the largest utility, regulated business, 15.5% ROE they are getting. Engineers India was trading at single digit PE multiple. So I think that is where you start seeing a compelling buy, but then you will also have to wait out because it may happen that these triggers may take some time to pan out, but you are sure that there's a significant margin of safety because the stock price is not factoring in excessive growth, valuations are cheap, fundamentals are strong, but it has to get a proper cycle.
All right. Now, we noticed that both the DSP ELSS and DSP Opportunities funds that you co-manage, both of them have a significant overweight in the financial sector. Could you please explain the reasoning behind this allocation?
Yeah, so see, the point is that if you look at the financial sector, it has gone through a phase of underperformance for the last 4 years. So when you look at, again, looking at a framework of margin of safety, you know, index weight, and, the ability for these stocks to deliver return, we think that at these multiples and because of this underperformance, there is a significant uptick which can come in the financial services sector stocks. So I think that is where you need to take a call and build higher weights when you are having a very convincing view that from here onwards the margin of safety is pretty high. We will not see any significant derating. How the interest rate cycle is panning out, how overall economy is moving, and even if you look at the capex cycles, so there will be a re-leveraging, so credit growth rate can come in. So I think all these factors make us believe that if at this point of time we have to look at, then financials makes a very good sense to be going overweight. That is what I mentioned earlier also. These are the discussions which we'll have internally between me and Rohit, that okay, that this is a sector now which has gone through the painful phase. Now this has happened, when you look at real estate sector for last 8-10 years, the sector was not performing. Power sector for such a long time was not performing. But when it started performing, then the re-rating was very significant. So I think that is where we see that financials will have that ability, and we are, overweight on that.
Just think another thing was, markets are at elevated levels. We have seen last year we have seen markets going up. There has been a little bit slightly correction, but if you look at the portfolio, then top holdings of both the pure equity active equity funds remains identical. So is it a deliberate strategy, or you are not finding enough opportunities given the high valuations of the market?
Yes, so I think you answered it right. When you look around, so there are very few pockets where you can find value. So as a value-oriented investors, and where our focus is to deliver on return, and valuations are very important parameter. So we are finding very less opportunities where we can allocate a significant amount of capital. So that is where, when you start thinking that, okay, that these are the stocks which have got such a good runway of, uptake from here, while there's a large part of the market which has become very expensive. So then you will always have a similar kind of strategy in both the funds, because then you will not be, because the pockets of, where you can get good returns are very limited. That is the main reason that you are finding this very similar in terms of the weight allocations. Yeah.
All right. Now, finally, addressing performance, the DSP TIGER fund has underperformed compared to the benchmark over the past 4 years. So what factors do you believe have contributed to this underperformance, especially given the sector's rally during this period?
Yeah, so see, the point is that when you look at the benchmark, you have to also look at the constituents of the benchmark. And as a house, we have a very strict framework in terms of what are the kind of companies which will invest in. We have a forensic analyst who will make sure that all these companies pass through that forensic test. And if those companies are not passing through that forensic test, we will not invest in those. And that is what is happening with the benchmark, that the benchmark constituents are so skewed towards certain companies with very high weights where our comfort is not there, either on the valuations or on the financials front, which we cannot take a call on. So I think that is what has led to, when you are comparing this to a sectoral benchmark, which is a benchmark which is prescribed by SEBI. But when you look at the broader markets versus a thematic fund, then the performance has been really better. So I think it is more to do with the constituents of the index, which is showing that. Another thing is that if you look at the Tiger fund, we have taken a call that we will not invest in lenders. And in the recent past, what you could see is that there are certain lenders also which are in the benchmark, which have gone up significantly. So I think these are the periods where your framework, your process, all those help you to maintain your thought process in terms of what you are investing for, what kind of companies which you want to buy, and not waver off that just because these stocks are doing well and on narratives you are going to add them. So we always stay away from narratives. We always stay away from companies where we think that financials are not comfortable or the forensic tests they are not passing. And those are the factors which could show this kind of an underperformance versus the sectoral indices. But that's the nature of the indices, where these are very strict in terms of the prescribed by SEBI, which we need to follow. Yeah.
Sir, but how do you deal with then thing the sector? There is you need to benchmark against the scheme against the sector. So how do you deal with the underperformance of particular with that benchmark?
So see, the point is that there will be then periods where you will see this kind of an underperformance coming in. But then when you look at the longer term, that is where the thing starts normalizing. And then there is also particular, you have Nifty 50 and the other benchmarks which are there. So see, what happens is that you can have one is a benchmark, but you also have your own framework and the process to follow. And it is not that the return which the fund has delivered, they are any less. But just following that, okay, that my benchmark is having these constituents and I want to hold them. So if you look at our holdings also right now, they are very benchmark agnostic, because this is more about picking right stocks, good quality companies, which we think we can ride on. See, as a fund manager, I also have a very important fiduciary duty. We are managing people's money. It means that we need to invest in stocks which are good quality. And that is what you have seen in the past cycle. Why people are still afraid of the infrastructure sector? Because of the fact that everybody got swayed that these are the stocks which are doing well. So when there's a bull run, the high beta stocks, the high risky stocks, they will continue to fly. But that is where you need to have a discipline. But when these things revert, that is where the process comes for the saving, and the framework helps us. So I think over the longer term, then you need to see, because we have seen significant run up in some of these stocks, which has led to the benchmark doing extremely well. But when this reverses, then what will happen?
All right, with that, we've reached the end of this conversation. Thank you, Charanjit, for taking the time for this interaction. Thanks a lot.
Thanks, Ruchira. Thanks, Chirag. Thanks
Thank
for
you.
having me. Yeah.
Thank you.